Want to have one of the world's best compounders compounding your money? Looking to get an ultra high quality dividend growth stock on sale after it's fallen by 1/3? Interested in learning about a terrific business that has some of the best fundamentals I've ever seen? Then you have to check out today's video.
He is a best-selling author.
30-year-old Jason Fieber has a plan.
This guy retired at only 33 years old.
I don't know if I know too many people that have accomplished something like that.
He's really kind of a guru when it comes to passive income.
Before I get into today's content, please give us a big thumbs up if you find value in our videos. Helps us to get the word out and grow the channel, and I'd really appreciate it. And make sure to stay tuned until the end of the video for a special news announcement. I want to tell you about a high quality stock that pays big, growing, reliable dividends. These growing dividends are funded by growing profit because this business is one of the world's biggest and best providers of IT services and consulting. What do we know about business in the 21st century? It's more global and more digital than ever before. Companies left and right are having to up their game and digitize operations. But how do they do that exactly? Well, that's where the likes of this business step in and help. And that is just one example of what they can do. This company has nearly endless ways to make money, and that's why it continues to grow its revenue, profit, and dividend like clockwork. I've personally invested in stocks just like this one on my way to going from below broke at age 27 to financially free at 33. By the way, I explain exactly how I achieved financial freedom in just 6 years in my early retirement blueprint. If you're interested, you can download a free copy of my early retirement blueprint using the link in the description of this video. Getting back to the stock I'll tell you about today though, perhaps best of all, it looks undervalued right now. Price is what you pay, but value is what you get. Why is that important? Because buying a dividend growth stock when it's undervalued should provide for a higher yield, greater long-term total return potential, and reduced risk. With this in mind, I want to share with you an opportunity I recently came across in shares of Accenture PLC, which appear to be trading at a significant discount today. Accenture PLC, stock ticker ACN, is a professional services company specializing in information technology services and consulting. Founded in 1951, Accenture is now a $183 billion by market cap consulting behemoth that employs 738,000 people. The company reports results across 5 operating groups: products, 30% of fiscal year 2022 revenue, communications, media, and technology, 20%, financial services, 19%, health and public service, 18%, and resources, 13%. Accenture is one of the largest IT services companies in the world, providing a range of consulting, strategy, technology, operational, and outsourcing services. Simply put, Accenture helps to solve problems for enterprises. Properly navigating the digital transformation would be one example. Formulating a strategy for entering new markets might be another example. The combinations of enterprises, problems, and solutions are nearly endless. And that's what's so exciting for Accenture and its shareholders. Enterprises aren't going away, and neither are problems which need solutions. In fact, doing business today is more complex and technology-driven than ever before. This is part of why Accenture has such a rich legacy for revenue, profit, and dividend growth, which looks set to continue for years to come. To date, Accenture has increased its dividend for 18 consecutive years. Will Accenture be a dividend aristocrat in 7 years? I believe so. The 10-year dividend growth rate of 10.5% is impressive. What's even more impressive is the acceleration in dividend growth. The most recent dividend raise of 15.5% is a perfect example of that. Now, you do have to sacrifice some yield in order to access that high dividend growth rate. The stock's yield is only 1.7%. That said, this is 30 basis points higher than its own 5-year average. And what's really great about the dividend is the safety of it. The payout ratio is just 38.8%. That gives the dividend plenty of room to head higher over the coming years. For younger dividend growth investors who are interested in compounding their money at a high rate over a long period of time, these dividend metrics perfectly fit the bill. Looking at business growth, Accenture moved its revenue from $30.4 billion in fiscal year 2013 to $61.6 billion in fiscal year 2022. That's a compound annual growth rate of 8.2%. Strong top-line growth. I usually look for a mid-single digit top-line growth rate from a large, mature business like this. Accenture shines. Meanwhile, earnings per share grew from $4.93 to $10.71, which is a compound annual growth rate of 9%. More good stuff from Accenture. What's especially remarkable is the way in which that 9% EPS compound annual growth rate was achieved. It was almost completely secular, with a steady march upward from year to year. It's clockwork-like growth. We can also see a tight growth correlation between earnings per share and the dividend over the last decade, which shows excellent control from management. Looking forward, CFRA believes that Accenture will grow its earnings per share at a compound annual rate of 9% over the next 3 years. Clearly, CFRA is not stepping out on a limb here, but I actually like that. Accenture is a model of consistency, as I just alluded to. CFRA sums up the investment thesis well with this passage, and I quote, Accenture is operating at a high level as it takes share and outgrows operating markets by about 2x. More recently, Accenture has been able to buck industry trends around more protracted sales cycles, posting bookings of approximately $22 billion, up 13% year over year in Q2, highlighting its unmatched scale across consulting, integration, and managed services, coupled with its enduring client relationships, such as in Q2, where there were 35 with $100 million in bookings, unquote. I mean, I'm not sure what more you can say. If that doesn't give you an idea of Accenture's quality, I'm not sure what will. However, just in case you need a bit more, CFRA then follows it up with this, and I quote, "We regard Accenture as a high-quality name that holds up well in a slowing macro due to its diverse industry reach and client relationships, sound financial positioning, and proven track record of compounding earnings at an above-average rate," unquote. I'll take CFRA's projection as the base case. That sets up Accenture for at least high single-digit dividend growth over the foreseeable future. And with the payout ratio being as low as it is, I actually think it's quite possible, even likely, that we see low double-digit dividend raises over the next few years or so, which would be right in line with Accenture's recent history. The dividend growth could then settle into a high single-digit range thereafter. Essentially, we're looking at a compounding machine that's still full of fuel. Moving over to the balance sheet, Accenture has an extremely strong financial position. The long-term debt is negligible here, and the interest coverage ratio is almost 170. Furthermore, Accenture has more than $6 billion in cash and cash equivalents. This is a pristine balance sheet. Profitability is magnificent. Over the last 5 years, the firm has average annual net margin of 11.1% and annual return on equity of 35.1%. The return on equity looks even better when you see that it was achieved without a lot of debt. Accenture is a terrific business with high returns on capital. Simply put, the fundamentals here are among the best I've ever seen. And with scale, brand/reputation power, switching costs, industry know-how, entrenched relationships, and IP, the company does benefit from durable competitive advantages. Of course, there are risks to consider. Regulation, litigation, and competition are omnipresent risks in every industry. The company is sensitive to the overall economy, as less businesses and less spending will reduce demand for Accenture's services. Consulting firms are uniquely reliant on their employee base, and talent retention is important. Technology continues to evolve at a rapid pace, which means Accenture must continue to stay ahead of the curve and maintain its edge. The company's large scale is an advantage, but it also may start to work against the firm by introducing the law of large numbers. The work from home trend could lead to more decentralized, cloud-based workloads and less growth for Accenture. Accenture's reputation carries great value, and the company must guard against anything that would damage this. A global footprint leads to geopolitical risks and currency exposure. Overall, in light of the very high quality of the business, I see these risks as manageable. And with the stock down about 1/3 from its all-time high, the valuation now looks about as attractive as it gets for this name. The price-earnings ratio is sitting at 25. For this kind of quality and growth, I find that to be quite reasonable. For perspective, its own 5-year average PE ratio is 28.8. We can also see a disconnect on the cash flow multiple. The current price to cash flow ratio, 7.2, is well off of its own 5-year average of 9.1. And the yield, as noted earlier, is higher than its own recent historical average. I valued shares investors using a two-stage dividend discount model analysis. I factored in a 10% discount rate, a 12% dividend growth rate for the next 10 years, and a long-term dividend growth rate of 8%. That strikes me as a reasonable view on Accenture's near-term and long-term dividend growth potential. The payout ratio is low, the earnings power is high, and the most recent dividend raise was over 15%. It's impossible to say exactly how things will balance out from year to year, but this seems like a realistic expectation over the next decade and beyond. I wouldn't be surprised to see Accenture do a bit better than this, but I would be very surprised to see them do much worse. The dividend discount model analysis gives me a fair value of $339.22. The reason I use a dividend discount model analysis is because a business is ultimately equal to the sum of all the future cash flow it can provide. The dividend discount model analysis is a tailored version of the discounted cash flow model analysis, as it simply substitutes dividends and dividend growth for cash flow and growth. It then discounts those future dividends back to the present day to account for the time value of money, since $1 tomorrow is not worth the same amount as $1 today. I find it to be a fairly accurate way to value dividend growth stocks. Morningstar rates ACN as a 3-star stock with a fair value estimate of $258. CFRA rates ACN as a 5-star strong buy with a 12-month target price of $333. I came out very close to where CFRA is at, and I think Morningstar is a bit too conservative on this one. Averaging the three numbers out gives us a final valuation of $310.07, which would indicate the stock is possibly 13% undervalued. Here's the bottom line, guys. Accenture PLC is an ultra high-quality business that has some of the best fundamentals I've ever come across, with a market-like yield, a double-digit long-term dividend growth rate, a low payout ratio, almost 20 consecutive years of dividend increases, and the potential that shares are 13% undervalued. This could be a rare window of opportunity to invest in a world-class compounder. And now for a special news announcement. Microsoft Corp, stock ticker MSFT, has done it again. The Q3 report was stellar, beating on both the top and bottom lines. The stock shot up by over 7% after the report came out. Microsoft, guys, is a beast. We recently named it as one of the top 5 dividend growth stocks to consider owning forever. With Microsoft having the early lead on AI, which is still in its infancy, the future looks better than ever. Do not underestimate Microsoft. Thanks so much for watching. I hope you enjoyed today's video. Give us a like if you did, and let us know in the comments what you think about this stock. Please make sure to subscribe to the channel and ring that notification bell so you don't miss out on new content. Also take a look at the description box below for some important links, including a link to my personal stock portfolio. This 6-figure portfolio, which I call the Fire Fund, generates enough passive dividend income for me to live off of. It'll allow me to retire in my early 30s. I've made my portfolio entirely accessible over at Patreon, and I also post alerts there whenever I buy or sell stock. I put my money where my mouth is, and I'm often invested in the same high-quality dividend growth stocks that I make videos on. Over the years, I've heard from thousands of investors who've been profiting from many of the same exact stocks that I own. So if you think this is something that you could benefit from as well, check the link in the description to see my portfolio and start getting my buy and sell alerts. I'll see you next time.